Have you ever considered investing in a financial solution that gives you a smoother investment experience and maybe more stability at the time of turbulence? What if I tell you this strategy might also help you avoid taking sudden emotional decisions when it comes to managing your money? Well, I'm going to take you through such an interesting investment solution today in this episode of One Step Ahead show by DSP Mutual Fund. And I have an investment expert who's already an audience's favorite for sharing his sharp analysis and crisp, clear thoughts about financial markets, economy in general, and investment solutions. Sahil Kapoor, Head of Products and Market Strategist, DSP Asset Managers. Welcome to the show, Sahil.
Thank you very much, and thank you everybody for joining.
So let me tell you a little bit about Sahil. He has a wide range of experiences across businesses and asset classes. Having started his career 16 years ago as a research analyst and then as a discretionary trader at Edelweiss Market Desk, later Sahil moved on to the wealth management business. In his current role at DSP, he leads the products vertical and also helps strengthen macroeconomic tracking for the investment team. Sahil has a master's degree in financial markets from ITM-IFM and a graduate degree in science from Punjab University. Beyond work, Sahil is a chronic reader and a fitness-focused person. So Sahil, I once again welcome you to the show. But before I start the conversation, I request all our viewers to share their questions in the comment section, and we shall get back to you at the earliest. So Sahil, let's begin our conversation. I have often heard people referring to this category of funds as asset allocation funds or multi-asset allocation funds. Some refer them as hybrid funds. So in an environment like this, clearly a multi-asset allocation strategy is finding its own footing. And we all know DSP Mutual Fund has launched its multi-asset allocation fund recently. There are other mutual fund houses who have been launching this category of fund as a part of their new fund offers. So Sahil, my first question to you is, why are multi-asset allocation funds gaining so much of popularity now? And why do these funds exist?
So, Sumana, I think one of the most important aspect of investing is that most investors make mistakes, right? That is the starting point. And usually the mistakes are costly, right? So we've seen in the past that, for example, even when indices give you, let's say there is hard data to back it up, that when US indices has given returns of about 10% beating inflation, an average investor has made less than inflation returns. That means they have not been able to beat inflation in US. Similar data exists for India that people don't make as much money. And the reason for doing that is too much activity. People end up chasing a few asset classes which are performing well. And maybe we'll talk about this in more detail. But one problem is the behavioral problem. So when you look at investing, there are three important edges. One is, the information edge. Today, all of us has equal information, whether it is a money manager or an average investor. Second is the intellectual superiority, right? That we'll know only after 20, 30 years. We can't know it today. And third is the behavioral aspect. That means how long-term oriented you are, how much mistakes do you make. I think this is the third aspect. Asset allocation funds or these category funds, they are a more mature way of investing. And I think they allow you to have this third edge inbuilt because of the structure of this strategy, right? We will discuss the structure, what it is, but the most important advantage is that this structure allows you to have this third behavioral edge, which doesn't, make many mistakes, and it, stops you from experiencing, let's say, the worst outcomes. And that's why I think this is a very, very good and important category of funds.
Interesting insights, Sahil. Back to the basics, I would also want to understand for my audience, what exactly do you mean by asset allocation? In simple words, if you can tell us what is an asset allocation strategy and how are asset allocation funds different than multi-asset allocation funds, or are they the same things?
Sure. So let me give you a very small anecdote. So when I started my professional life and I got my few first paychecks, my mom told me that you must have some gold, right? You should buy some gold, maybe a gold jewelry or something, right? which will act as a investment over time. And my dad told me that you should go for an FD, right, which is one of the safest investment. One of my uncles who was very active in the stock market said that you should buy some stocks, right, because they are the best investment over a very long period of time, right? So this is the structure of how most of our people, most Indians have invested over a very long period of time. They have always selected a few number of assets, different type of assets, and that is how our financial portfolios get created. So multi-asset is a better way of doing it. That means a structured approach of creating a portfolio, because more often than not, people make a mistake of having only one asset class. That means putting everything that they have in FD, or putting everything that they have in gold, or just going all out and buying as much stocks as possible without thinking what will be the consequences. So I think a multi-asset allocation is that, for example, if you have 100 rupees today, how will you allocate that 100 rupees to, let's say, stocks, to bonds, that is the debt, and to gold and other asset classes? So what is the right proportion? What is the right mix? And let's say if you arrive at a mix that I want to put one third, one third, one third each in these three asset class, 33 rupees each, it will give you a broad structure of a multi-asset allocation framework. That means you are exposed to different assets which follow different economic cycles, and it will give you a better experience over time.
Great. So, Sahil, as you were narrating your example of choosing or preferring different types of asset classes and then allocating your money across these asset classes, this entire process seemed to be, quite disciplined, but at the same time, not very easy. But, let me give you an example from a recent conversation that I had with one of the participants of our financial wellness sessions. So this young techie, he just told me, I started investing in 2020, and since the time, after COVID, I became much more aware that I need to manage my money, and I started investing. But I found my investments growing amazingly. I made a lot of return. And in fact, I'm telling a lot of my colleagues that investment is quite an easy thing, and you all should start doing it. What clearly seemed to me is that this person has not yet gone through different market cycles, may have not experienced the various nuances around investing, and hence it seems easy to them. So while you interact with your participants, in your sessions, in your conversations, do you also observe such behavioral pattern, and what would be your advice for these set of clients who says investment is quite easy?
So, Shumana, our confidence is inversely proportional to our experience. So when we start, we are very confident. We believe that we know everything. And over time, as we learn the art of investing, we understand that we know very little. So our ability improves over time and confidence comes down, because we begin to understand that it's not very easy, right? And second and more important point is that there is something called as an illusion of knowledge, right? We believe that because we have made certain amount of returns over a short period of time, those returns have been made because of our knowledge and understanding. These may not be the best frameworks to look at investments per se. And we have over time seen that whenever markets are easy and the money making is an easy process, right? You are making quick buck in the market. Those are the moments where we learn these wrong lessons. And when do these events occur? Usually in a bull market. I have made this comment earlier also, that one of the best time or the best phases of learning for investor is a bear market, not a bull market, because you learn some good lessons in a bear market. And also, when do these events occur? Of course, in a bull market. Second, when there are very large IPOs, a lot of new investors are attracted towards equity markets, right? And they come and participate in equity markets. And if they get a very good initial response, they become sort of addicted to that initial response, and then that is where the mistakes occur. So I think it's not very easy to make a large amount of return from the market for a very long period of time. It might be easy for a short period of time, that is true, but it may not repeat. So if you look at the numbers in the last 25 years, let's say even if you just look at Nifty, our returns are somewhere close to 13% CAGR, right? But if you just flip this data and start from the peak of 2008, that means you was attracted to the market when the bull market was just about to end, your CAGR falls to about 8.5%, which is just equal to the returns of our bond market. They are not very different, right? So the idea is that you can get attracted to very high returns and participate in a bull market, but they will create trouble for you, largely because your experience could be much more shallower. And asset allocation, I think, comes in here. It provides you a cushion, an opportunity to split your exposure across assets, and that could protect you from these mistakes. That means having, let's say, incorrect expectations of very high returns.
Absolutely. So, what we have also learned from from these multi-asset allocation strategies, there are two sides, of the possible outcome. What could be one could be earning a smooth investment experience, like you had highlighted, and also maybe a little more stability at the time of turbulence. Do you think these are significant reasons for someone to consider this fund category for long-term investing? And also, is it important that that downside also needs to be protected in one's portfolio? What's your view on that?
So one point is that this kind of asset allocation strategy will definitely provide you a smoother journey, and that is by design. Okay, so let me paraphrase it, saying that this is a very robust structure. And why is the structure robust? Because it is exposed to four different assets. For example, Indian equity, global equity markets, debt, and gold. And many of these assets are uncorrelated with each other. So, for example, just to give you an illustration on how it has worked in the past. So, if you go back and see last 25-year data, Nifty CAGR returns will be around 13%, gold CAGR returns will be around 12%. But if you create a portfolio of 50% each and rebalance them every year, the returns improve to 13.5. So they are not the arithmetic mean of 12 and 13, which is 12.5, but they are higher than either of the asset class. And the reason for that is the uncorrelated nature of these two different assets, right? So when you mix four assets together, there is a possibility that the outcomes will be much more smoother. And those smooth outcomes will help you tide over volatility. Second is also the drawdowns will be shallower, right? So for example, past data shows that if you have a multi-asset allocation framework or a strategy, your volatility, or let's say standard deviation of the portfolio, is roughly half than that of the equity market, right? So it falls lesser. So for example, if a COVID-like event occurs and let's say the Nifty index falls 30%, a multi-asset portfolio may fall only 15 or lower, right? Which is a very crude way, maybe mathematically slightly incorrect of saying, but roughly it is what it is, right? This is the kind of experience that you will get. And this is also true on the upside. That means if the market were to rise, let's say 40-50% over a very short period of time, a multi-asset allocation fund will not rise 40-50%. So it will not give you equity-like returns over a 1 or 2 year or a 3-year period, right? So you can imagine it as pulling out from extremities on both sides, on the upside and downside. And therefore, the point to note is that these strategies are less volatile. Okay, and we may discuss why they are less volatile, and why does it make sense. But the point is that they are less volatile and they give you a better and smoother experience over time.
Sure. And are there different ways to allocate these asset classes? And what is the right and wrong way of allocating these assets? If you can highlight a little bit on that.
So one thing is that you could be the best in the world and find out that what is the best performing asset class in each year. If you were to do that, your returns will be exceptionally high. But we know that nobody can do it, including me and including anybody else, right? So even if you get better half the time, your returns will be very high. But let's assume that we don't know how to do it. And if you just split it 25% each into Indian equity, global equity, gold, and debt, 25, 25, 25, 25, that is 100 rupees of total assets. That also gives you a very, very smooth kind of a journey, right? So I would say that the right way of doing it is to split your exposure across assets. If you are running a multi-asset strategy and if you have let's say only one asset class, let's suppose Indian equity, with let's say 70-80% of your exposure all the time, then roughly you are not running a multi-asset allocation fund. You are just running a aggressive hybrid sort of a strategy. So I don't think there are any exactly the best way of doing it. There are many best ways, but the good way of doing it is to split your exposure across all four asset classes appropriately at different points in time. And largely, I think the returns are made through equity exposure, because all of us know that good companies will earn more than their cost of capital or cost of debt over time, and therefore their share prices will help you create wealth, right? So debt will not allow that, because companies are able to earn more than uh, cost of capital. Gold, of course, is a store of value. At times it also helps you in creating wealth, and of course global equity also will allow you to create wealth. So the key bulwark of wealth creation, even in a multi-asset strategy, will fall on the equity portion. But gold and debt will act like seat belts when you drive a car, right? If there is an accident, it will save you from very high volatility.
Great. That prompts me to ask you another interesting question that might come to investors' mind quickly. Can't investors create these multi-asset allocation structure on their own and manage it on their own by choosing asset classes that you just mentioned and rebalance it on their own way? Is that possible, or is it important that someone follows a mutual fund framework? Why one should not do that?
So yes, of course, investors can do it, and I think a lot of investors who become seasoned over time, they do it on their own, right? They've been doing it, but there are two, three, let's say, suboptimal ways that people follow and investors follow. First is that investing across equity sectors. That means you take 100 rupees and you think that you want to diversify. You end up buying different sectors. Let's say pharmaceuticals being defensive, IT touted as being defensive, etc. You split your exposure across sector thinking that this will protect you from volatility and market crashes. It doesn't. Similarly, a lot of people also split their exposure across market cap, but eventually it is only equity, right? So you get that suboptimal experience of seeing very large drawdowns when a crisis occurs. So it's not a great way to do it. Second is a better way of doing it, splitting your exposure across four assets or three assets, but doing it on your own. But when you do it, every year when you rebalance, you have to pay tax, right? And that tax becomes a very big burden on the investor. How big is that burden? Let's look at a very long term to understand. So, for example, if you started with $1 billion in 1900, okay, and you continue till 2020, investing in, let's say, US equity, which have given real returns of 7.5%. Let's assume 7.2%. It will be mathematically easy, right? So 7.2% CAGR return, every 10 years, your money doubles, right? So in 10 years, 1 billion becomes 2 billion. And then another 10 years, it becomes 4 billion, etc. So by the time you reach 2020, that 1 billion would have become $2 trillion. But if you were to pay 13% tax every 3 years, that 2 billion would have become only 800 billion, or 2 trillion would have become only 800 billion, less than half. So that is the big tax leakage which happens over a very long period of time when you do it on your own. Within a mutual fund structure, there is no tax leakage. So for example, within a mutual fund structure, if you have, let's say, 40% Indian equity, and let's say you had 30% gold and other asset classes, and let's say market falls very sharply, and you want to increase your equity exposure, rebalance your portfolio, you move 20% out of gold and buy Indian equity. Within a mutual fund structure, there will be no tax incidence. So that makes this structure a very, very robust strategy inside a mutual fund framework, because it helps you in stopping that tax leakage and your money keeps on compounding over time. And I think we know that compounding is a very, very powerful tool if it is not disturbed. So within a mutual fund structure, it will not get disturbed. And therefore, I think there is absolutely no comparison in DIY, a multi-asset strategy versus a mutual fund. Mutual fund, of course, will be much superior.
Great. I think we have some solid reasons why one should stick to a mutual fund framework while selecting a multi-asset allocation fund rather than doing it on your own. And Sahil has very well explained those nuances. Before I move on to the next set of questions with Sahil, to all the audience here, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get latest video updates from DSP Mutual Fund. So Sahil, my next question to you is on the performance of market, a multi-asset allocation strategy. So far, we have understood what is a multi-asset allocation strategy, how is it different from basic asset allocation, what are the different structures, why it is important to select a proper mutual fund framework to invest in these funds. My next question is around the performance. Under what situation a multi-asset allocation strategy may not perform well? Do you think at present, when the markets are at all-time high and the valuations are also high as well, will a multi-asset allocation strategy or a fund work in such situations for the next few years or for the coming years? And are there any other reservations our investors should know about this category of fund?
So let me first highlight when does it not work, right? Or let's say on a relative basis when other strategies are more important. For example, if you were sitting in March 2020 when markets had already crashed due to the COVID crisis, it made little sense to look at a multi-asset allocation fund at that point in time from a returns perspective, right? Because markets were cheap, they're close to 52-week lows. Usually equity returns will be very, very high, right? From that point onwards, because equity markets are very cheap, right? So when equity markets are excessively cheap, you have crises and crashes. From that single point, it makes sense to have large equity exposure. So maybe a multi-asset could have less returns over time in a same comparison 1 to 3 year period. But let's ask ourselves a question. Every time we make an investment, there is a question that we ask. Is the market expensive? Where should I invest? Which sector? Which market cap? Are the debt returns good enough? Right? Is gold going to go up or go down? Is it good enough? These are the questions that we grapple every day. In the multi-asset allocation strategy, you don't have to ask this question. The reason is that there are all 4 assets. One of them will not be doing well, or maybe only one will be doing well at that point in time. So you will always end up buying assets which are right now not doing well, but could do well in the next few years. So basically, you already have the winners of tomorrow in your portfolio because they are not doing well today. Okay. So past returns show that over a full cycle, over a 20-25 year cycle, multi-asset returns are, debt plus or equity minus kind of returns. They sit in between these frameworks, or maybe get closer to equity return over a very long period of cycle. And the reason for that is that when market crashes occur in a multi-asset framework, you are able to switch out from gold, debt, and other assets and enter equity markets. Because at that point, your equity allocations could be lower, right? So a multi-asset allocation could switch you back into equity. And that is very, very useful framework. So over time, I think it helps you probably get the better asset class in your mix and avoid what is expensive. So you asked a question that because valuations are high today, I think it makes almost all the more sense today, because the history tells us that when equity valuations are high, it makes sense to mix other asset classes in your portfolio, and your returns actually improve if you buy non-equity asset classes like gold, debt, and international equity. So they actually enhance your returns and they reduce your volatility. And I think that last point is extremely important, reduction in volatility, which a multi-asset strategy allows.
Great. So let's know a little more about this new fund offer from DSP Mutual Fund, the multi-asset allocation from DSP's house. Could you tell us a little more about this fund? How is this asset allocation structure made in this fund, and why is it made in such a way for our investors?
Sure. So first is the why. I think that is something which is very, very important. And what we've seen is, as I initially said, the behavioral mistake. A lot of investors end up redeeming at the wrong time when they see very large cuts to their portfolio. And it is very behavioral in nature, right? When you see your portfolio, it is down 25-30%. you will become very, very apprehensive of what the future is like, and you would want to go to the safety of, let's say, an FD or debt returns, right? And that is where the mistakes are made. So this strategy, why we have created is, it allows, as I said, less volatility. So when crashes occur, this strategy will fall less. How does that help? Your chances of making mistakes will be lower when your portfolio values do not decline as much in a crash. So for example, let's assume that there is a COVID-like crisis, markets have fallen 25-30%. But if your portfolio is down only 5-10%, you will still have the ability to hold on to it, right? And within your portfolio, it is automatically buying cheaper equities, increasing your exposure so that your returns could improve. So the framework that we have created has been made keeping these aspects in mind, that they should help investors avoid these behavioral mistakes, stay invested for a very long period of time, and give them exposure to all four asset classes, which is equity, debt, gold, and international equity. And we believe that all four asset classes are very important in the mix. You cannot have only one overpowering the other three. And therefore, structurally, what we have done is that Indian equity at all times bare minimum will be 35%. On average, they will be 50%. Global equities will be around 20%. Gold, again, on an average, will be around 20%, and debt exposure will be around 10%. So these will be the average exposure in DSP, Multi Asset Allocation Fund, over a full cycle. They will vary depending on how these assets are moving, how their valuations are moving. Are they cheap enough, good enough to increase allocation? Those decisions will be taken actively, but this will be the broader experience. And we believe that this structure has inherent strength. It will provide a much smoother experience over time.
Great. So you mentioned we also have exposure in the global equities or international equities. So which all countries and sectors are covered through the international equities? And what kind of underlying instruments are we using? Is it only stocks, or are there other instruments also that we are using for this allocation?
So Shumana, there is a confluence of top-down and bottoms-up approach here. So once we get the allocation number from our top-down model and our investment committee, for example, let's say that number is 20% allocation to global equities, then on a bottoms-up scenario, we have about a universe of about 3,000 stocks globally. Then those stocks are filtered basis their valuations, business value, business cycle, and growth matrix. Then we end up having, let's say, a basket of about 600 to 700 stocks. Then those stocks are, sorted for the quality of their business based on our proprietary models. Once that list is made, we get a broad list of about 200 businesses where we are comfortable taking global exposure. They can be in various countries. So the countries which are coming up in most of our analysis is US, Eurozone, which is a broader term, Japan, some other smaller exposure to very small exposure to countries like China and other Asian countries. The point is, high quality companies exist across the world, and we want to leverage the quality of these companies, have exposure to many of these companies across the world. We are going to use two formats. One, investing through ETFs wherever the large cohorts where we want to take exposure are present. Second, also the ability to directly invest in active schemes or directly to stocks whenever there is an opportunity. So both these options will be open. So across geographies, across sectors, and utilizing both ETFs and direct equity as a platform to invest.
Great. My next question is on the different caps when it comes to choosing equity stocks. Investors generally perceive small and mid cap space to be a little high risk, high return space, provided they stay invested for a longer duration of time. Keeping that in mind, when it comes to DSP Multi Asset Allocation Fund, do you have a proposed breakup between large cap, mid cap, small cap stocks, or is it going to be dynamically managed?
So dynamically managed is the right word. We think that we'll have a diversified exposure across market caps, and the decision will largely be more active. driven by what is the valuation comfort in each of these market caps. So we've seen cyclically that there are times when small and mid cap becomes very attractive based on valuations. Of course, at those times we'll have slightly higher exposure to them, but you could assume that the overall complexion of the equity exposure will be slightly large cap heavy. So if you were to, let's say, put a broad framework around it, between 2/3 to 3/4 will be large caps and rest will be mid and small cap based on in which cycle are we. So sort of a multi-cap, flexi-cap kind of a framework or an exposure framework for this category is what we are envisaging.
Great. Also, Sahil, at some point in time, you had mentioned, taxation is an important aspect into these funds. So we have seen in the industry, there are multiple types of multi-asset allocation funds, some with equity taxation, some with debt taxation. Should investors worry on the taxation aspect? Should that be a decision criteria for choosing these funds? And what's the taxation structure for DSP Multi-Asset Allocation Fund? If you can also take us through that.
So DSP Multi-Asset Allocation Fund will follow the erstwhile debt taxation, where the tax will be 20% and there it will have indexation benefit. And why will this structure, occur for DSP Multi-Asset Allocation Fund? Because it is going to follow bare minimum 35% exposure to Indian equity at all times. So which gives it the ability to have indexation benefit. In the past, it was only available until 31st March to all debt instruments, global investments, and to gold. It is no longer available in those buckets now. So, but multi-asset allocation as a category, because of its 35% equity exposure, will have this benefit. So DSP multi-asset allocation fund will have this structure of erstwhile debt taxation with indexation benefit. The second point is that there are a lot other structures which have equity taxation, right? So when you look at debt taxation with indexation, it's 20%. When you look at equity tax, it is 10%. So on the face of it, it appears like equity taxation is, of course, much more beneficial. But let's look at two aspects. One, when you get equity tax portfolio, you have to maintain 65% or more in Indian equities, which means that you end up with only 30 or 35% exposure left for gold, international equity, and debt. So, which, as I said earlier, is not a multi-asset allocation portfolio. So, it is a Indian equity heavy sort of a aggressive hybrid. So it restricts your ability to go across asset classes, right? So that I think is probably a better way of doing it is to have a more flexible structure, which the indexation benefit helps you do that. And we have done some data simulation, which tells you that over a 3-year full cycle period, if you hold both these strategies, the outcomes, return outcomes adjusted for tax are more or less similar, right? It is more or less similar in both these buckets, looking at all the tax benefits. And there is this point of 1 lakh rupees extra tax benefit that you get every year from your mutual fund investments. That most investors are already invested. So if you take that into account, you will not get that benefit in multi-asset anyways, right? Because you are already availing that benefit in other investments. So even if you ignore that benefit, you still have better outcomes in a indexation, that is erstwhile debt taxation, multi-asset allocation fund. So both from a, let's say, tax treatment perspective, and second, from having appropriate exposure to 4 assets, right? We think that the structure that we have chosen is a superior one for investors over a longer period of time. And also, please don't forget that the lower volatility, which helps you not make mistakes, which is the core of a multi-asset allocation fund, occurs only because you have exposure to 4 assets. If you were to have equity with 65-70% exposure, again the volatility will go up, and your experience and the reason for doing a multi-asset allocation fund will get defeated. So these are some of the nuances that we kept in mind while designing this.
Understood. So, what kind of investors typically should be looking at investing in this kind of a product, a multi-asset allocation product?
So I think investors who don't want to worry a lot about, आज market क्या लगता है, I think that is something which people should think about investing in this fund. And I think all of us fall into that category, right? You don't want to again and again and again ask this question and then fret about whether to do it or not. So A, people who are really long-term oriented should look at this fund. B, if your investment horizon is anywhere between 5 to 7 years, I think there is no other better category to look at investing. And third, I think it is open for all sorts of investors, right? Whether they are small investors, whether they're informed and large investors. I think this is a fund which is possibly a better fit for all of us. Second thing is there was a lot of money flowing into debt category, gold, international investing, where they were availing a lot of taxation benefit. I think this category now gives that benefit. So if you want to mix that exposure in your portfolio, this again becomes a go-to category to have it in your portfolio. So I think it is appropriate for all sorts of investors for having exposure to other asset classes, plus also for investors who want to remain in the market for a very long period of time. This is the right product.
Absolutely. So Sahil, thanks so much for joining us today and sharing your analysis and insights on such an important category of fund, multi-asset allocation fund. And I'm sure our viewers now have much better clarity as to why they should consider this fund as a part of their portfolio. To all our viewers here, if you need more help managing your money, please click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Sahil, thanks once again for joining us here today. Have a good day.
Thank you. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.